If you're a federal employee or a retiree with a sizable TSP, here's what most people don't realize. The TSP is excellent at helping you save, but it doesn't help you decide when and how that money gets taxed in retirement. In this lesson, I'll start with TSP 101, explain where tax challenges show up in retirement, and then walk through a live demo showing you how a Roth conversion plan can be structured for an $850,000 TSP. If it's your first time here, welcome. I'm Dr. Amanda, and you're at the Retirement Income School. This is your place to get financial education on how to protect your wealth and create guaranteed lifetime income so you can retire financially relaxed. All right, let's dive right into today's topic for this lesson, which is converting an $850,000 TSP to Roth. Let's start with the basics. The Thrift Savings Plan, also known as the TSP, is the federal government's 401k style retirement savings plan. And its core purpose is to help federal employees accumulate retirement assets during their working years. This is going to be through employee and employer contributions that offer tax-deferred growth. And remember here I said that it's an accumulation strategy. And you want to think about how there are really three retirement phases. So there's the accumulation phase, and this is during your working years. You've got regular contributions, tax-deferred growth, employer matching. You're building up that big nest egg, in this case, in a TSP. Then you've got another phase, which is the tax planning phase. And this is during early retirement. Really, it could even start in the accumulation phase, but for a lot of people, this is going to be during early retirement. When you're thinking about income decisions for the future, Roth conversions, and doing really intentional planning around tax strategy. And then there's the distribution phase that's later in retirement. This is where RMDs start, taxable withdrawals, Medicare adjustments, survivor tax impacts. So you see how there's these three different phases. There's accumulation, there's tax planning, there's distribution. And it's important here to think about how focused we are on the savings portion. For so many years of our lives, we're saving, and thinking about building a big nest egg, but we forget the importance of tax planning across these phases. And that really ties well to our topic today because we're thinking about Roth conversion of TSP funds. And when we tie all that together, some of the challenges with TSPs in retirement are that, like we said, they're effective for saving. You've got tax-deferred contributions, tax-deferred growth, and employer contributions. But where this can cause a challenge is that at required minimum distribution time, you're going to have that increased taxable income, higher Medicare premiums, which is known as IRMAA, the income-related monthly adjustment amount on parts B and D, and higher marginal tax rates for survivors. I've talked about this in the past where you might have the widow's penalty happen where one partner passes and the surviving spouse is now taxed at a single filer tax status instead of a married filing jointly tax status. So that's where TSP has some challenges because it's really a vehicle for accumulation and savings. And now when we're in the distribution phase and we're thinking about income and we're thinking about strategy around RMDs, we want to start to consider the tax implications. So this is where a Roth conversion comes into play. You want to remember TSP is designed primarily for accumulation. It's not a tax management tool in retirement. An important update to consider in 2026 is that TSPs now are expected to allow Roth conversions, which does add some flexibility for participants who own TSPs. And you want to think about important limitations. TSPs remain an accumulation-focused strategy. They're not really designed for ongoing tax bracket management. And multi-year conversion planning may be operationally limited. So you want to think about the availability of Roth conversions for TSPs doesn't necessarily replace the need for coordinated tax planning. This is why a lot of people come to me. They'll say, hey, I've got this large chunk of money saved in a TSP. Now what do I do with it? How do I manage RMDs? I'm continually surprised by how a lot of wealth managers or financial planners sometimes are not talking to their clients about the decumulation phase because they're so focused on accumulation and they're good at it. That's their area of expertise. They're accumulating wealth for you. When we're thinking about distribution, we want to be thinking about RMDs and how that's going to impact you long term. So with all of that in mind, why might you want to plan Roth conversions outside of a TSP? Consider how a TSP might reduce flexibility for partial conversions. There's limited tax withholding control and just a lack of broader strategy coordination. So then rolling TSP assets into an IRA may allow for partial conversions, annual review and adjustments, better coordination with your income planning and Medicare situations. This can improve long-term planning and give you more flexibility, though it's not necessarily appropriate for every individual. So you want to be thinking, okay, the money that I have in the TSP, is it flexible? What can I do with it? What do I want to do with it? What's the goal? And if I want more flexibility and I want improved planning, then you might want to consider an IRA rollover. If you've been hanging out with me here in the Retirement Income School, you know that I'm an annuity fan and I talk a lot about annuities and using Roth-friendly FIAs, fixed index annuities for Roth conversions. So why might you want to consider this avenue with your TSP assets? And remember, in this educational example, we're using a Roth-friendly fixed index annuity to serve as a planning vehicle during the conversion years. The reason that we would want to use a Roth-friendly annuity is that it gives you principal protection, volatility reduction, internal tax payment options, and consistent execution. So when we take all of those into account, what we're doing is we're saying, okay, we've got this TSP, we're going to move it into a safe money bucket of an annuity, and that annuity is going to be an IRA annuity that we then do partial conversions year by year into a Roth IRA annuity. So you're taking your TSP, you're rolling it over into an IRA annuity, and then we're telling this Roth-friendly company, hey, Roth-friendly annuity company, we want to convert X amount this year and then next year. And what happens in that Roth-friendly annuity company is that they create a mirrored policy. So you've got an IRA and a Roth IRA, and by the end of the conversion time that's based on tax bracket management planning, then you've got all of that IRA money moved to a Roth IRA, and then the original IRA closes. So now you just have a Roth IRA annuity. What this does is helps you with long-term planning for your income or your assets to be tax-free growth, tax-free payouts. And that's why you might want to consider taking TSP, rolling it into an IRA, using a Roth-friendly annuity as a safe money strategy for you during this decumulation phase of retirement. So what I'm going to do now is walk through a case study with Sam and Sally Sample. This is a combination of many different types of clients who come to me with TSPs, and we're looking at a conversion strategy using an annuity. For this couple, we're going to say that they're 60 years old. They retired in January of 2026. So notice they're past the 59 and a half. They're past the rule of 55. They had careers as a senior federal engineer and a federal management role, which is why they have TSPs. Their assets and income. So they combined have a total of 1.5 million in their TSPs, and they're looking to convert 850,000 of it using a Roth-friendly annuity strategy that I'm going to show you in this walkthrough. They have $120,000 combined of annual pension income. They own a $500,000 home that's mortgage-free, and they have $250,000 in liquid savings. Their timeline is that they're going to wait to take Social Security until age 70. And for them, because they're 60 in 2026, their RMDs at the current time by law aren't going to start until 75. So they've got a long runway to convert this money if they're looking to do it before RMD age. If they're thinking about IRMAA considerations, then they want to think about converting money between age 60 and 62. Because remember, with IRMAA, there's a 2-year look back. So when they turn 65 and start taking Medicare, then that IRMAA is going to look back at what they had for income at age 63. So these are all things to consider uniquely for each individual case when we're looking at using this strategy. And let's consider their goals before I break this down for you in a Roth Blueprint. Their conversion goals of TSP to Roth IRA annuity are that they want to manage taxable income. This is them controlling income levels during the conversion process and reducing long-term IRMAA. They want to reduce the future RMD chain reaction problems. I've talked about this in other lessons where when RMDs begin, it causes a chain reaction. Your AGI increases, Social Security is taxed differently, QBI deductions can go away at certain income brackets, IRMAA charges increase, you've got the widow's penalty, and then inheritance taxes when you have forced RMDs versus Roth assets where you can pass that money on to your heirs tax-free. Another goal of theirs is to increase tax diversification and have a safe money bucket. They want to build tax-free retirement assets that are safe and protected. In this case, remember we said they had 1.5 million and they are wanting to convert 850,000 of it. So they're ensuring that they have a portion of their assets in a safe money bucket, an annuity. And they are looking for tax-free inheritance. They have 2 kids and they want to be able to pass on an IRA that's tax-free so that their kids aren't subject to the 10-year rule where they have to draw down the assets and add that income to their annual taxes. Also, this gives them the option for future Roth income, which would be tax-free if they choose to turn that on. Ultimately, it just gives them flexibility to have a Roth bucket that's safe. So now I'm going to walk you through using the Roth Blueprint software to show you what this would look like. And I want to remind you that this example is for educational purposes. It does not represent individualized financial, legal, or tax advice. You should always consult a qualified professional before making decisions about your retirement. What that means is that you're not going to use this video and say, this is the end all be all. This is just one case study of one couple. It's just an example. I have a lot of clients who will come to me and say, what's the magic formula for Roth conversions? There isn't one because there are so many variables to take into account for each individual. It depends on what your goals are. It depends on your timeline to do the conversion. It depends on your tax philosophy. It depends on if you have heirs that you want to pass money to tax-free. It depends on so many different things. So I'm just doing one example. If I played through every example of every scenario, we'd be here for 24 hours at least. So keep that in mind. This is just for you to understand what this process could look like. If you want your own individualized plan, schedule a consult with me. You can go to retirementincome.school and click on the button at the top of the page that says book a Q&A call. Okay, let's break this down. All right, just to get started here, you're going to see that I'm using my Roth Blueprint software. I'm licensed to use this when I have a meeting with you. We run through these numbers for your unique situation, but we're just using the example of the case study today. So this is a married couple. We're using a fixed index annuity. Sam Sample, he's age 60. Sally is 60 as well. They have $850,000 that they want to convert. And in this example, I'm going to use right now just a no bonus annuity with a 7% rate of return. One of the main annuities that we use right now, if people are wanting to pay taxes externally, meaning that they're paying out of pocket for the taxes on the conversion, well, then let's say we use a no bonus annuity, but there's a 10% cap on the S&P. So we can safely say that your average rate of return based on historical data is going to be 7%, which is actually very conservative, but we're just going to be conservative here. They want to convert up to the 24% tax bracket. Now, remember that the tax brackets are permanent until 2028. And so we know that at the top of the 24% tax bracket for married filing jointly, that's $403,550. That's the top of the 24% tax bracket. Now, Sam and Sally have the philosophy that taxes are going to increase after that. So they want to do the conversion more quickly. They're willing to pay for taxes on the conversion, and they're not starting their Social Security until age 70. They live in Texas, which is a no income tax state, so there's no taxes added there. They have $120,000 per year of pension income, like we said, combined. And then we're going to just start the conversion right away so that they can optimize 2026, 27, 28 at the rates that are known. Now we're just going to submit this and see what happens. So what you see here, once we submit all that information, is that they would have a 151% increase in their TSP wealth if they were to take that TSP, roll it into an IRA, use this annuity strategy to do a conversion over a series of years. Now, if we were to meet together, of course, I'd break down all these numbers for you. But for the sake of time on this educational video, I'm just going to go over some real basics. So if you see in this blueprint, the conversion details, if they were to convert at the top of the 24% tax bracket, well, they've got a taxable income of $87,800. And that's because they've got a standard deduction on their 120. And then that means that they could convert $315,750 in year one. In year two, they would convert $316,750, and in year three, $272,741. That would put them at the end of 3 years having converted everything to Roth. And what you see here is with the estimated growth from this annuity, and in this case, them paying taxes out of pocket for the conversion, they would end at year three with $1,041,287 in their Roth IRA from their $850,000 that they initially began with. Now, you say, well, I don't know if I want to pay that much in taxes. This tax bill adds up to $205,000. You remember we said that Sam and Sally Sample had $250,000 in savings. They could pay it out of there so that they maximize the amount that's going to the Roth. That's going to depend on their goals. Let's say that they want to have the maximum amount in that Roth, then they would consider paying out of pocket themselves. So externally, not from the gains within the annuity, so that they could keep as much money as possible in the Roth IRA. Let's say they don't want to do that. Many times I'll have clients who come to me and say, well, this is going to be an inheritance for our kids, and we're going to take the tax hit so that we can pass the money on to our kids tax-free, which means let's pay for the taxes on the conversion from the gains within the annuity. If they were to do that, then let's change these parameters and say internal. Remember we said they had $1,041,287. Okay. Now here's the difference if they decide, well, I'd rather pay the taxes on the conversion. In this case, we would use a different annuity. Usually, we would use one that has an initial bonus that then helps you pay for the taxes on the conversion. So in this case, if we change the parameters by now saying, okay, Sam and Sally decided that they want to pay the taxes from the gains within the annuity. So we chose a different annuity. This one's a bonus annuity, still no fees in this annuity, but it has a day one 11% bonus. Now you see that they have a 106% increase in their wealth instead of previously it was 151%. That's because they're drawing down some of their IRA money to pay for the taxes on the conversion out of the annuity, yet they had that gain in the annuity to be able to do that. And because they're giving this to their kids as an inheritance gift, the picture looks different. This is why I said this is such an individualized process, because it really depends on your goals, why you're converting, how quickly you want to convert, on the strategy that gets used. So in this case here, you see there's a day one bonus. So their beginning of year balance is $943,500. They distributed $315,000. That keeps them at the top of the 24% bracket. The taxes were paid from the gains within the annuity, $72,000, and they converted $243,000. But then they also gained from index growth. Now, this is going to vary some years, but on average, this 10-year contract annuity right now is performing historically at around a 5% growth rate. That is not guaranteed. That's going to fluctuate based on the index tracking the market, in this case, the S&P. So you see here, their end of year balance after having paid the taxes on the conversion is $951,669. Remember, they started with $850,000. So in this case, they're able to take the gains from the annuity, pay the taxes on the conversion, not out of pocket. And so now they have $951,000 at the end of the year. That's $100K more than they had when they started, even though they paid for the taxes on the conversion. And so remember, again, this is an example. These numbers are not guarantees. I just want to show you what this process looks like. And this gets done year by year. So in the case of paying the taxes internally from the gains in the annuity, it takes longer to convert because there's less growth, because you're removing some money to pay for those taxes. So in this case, you see here, it takes 4 years to complete the conversion at the top of the 24% bracket instead of 3 years. And at the end of those 4 years, the projection would be that they have 1,002,476 compared to the other where it took 3 years, and at the end of 3 years they had 1,041,287. So you can see there's some benefits and drawbacks of why you might want to pay for taxes outside of the annuity or from the gains within the annuity. And these are things that we discuss when we map out a blueprint together. We talk about your unique goals, the benefits and drawbacks of each strategy so that you can make an educated decision, and of course consult with your CPA. Now you see all these tabs. We're talking account values, taxable income, IRMAA, net income, conversion. We've got your baseline scenario and a Roth Blueprint scenario that we walk through all of this when we work together. It's too in-depth to go into all that right now, but I wanted to give you a big overview so that you could understand why you might want to use an annuity to convert your TSP to an IRA and then to a Roth IRA. Think about the benefits in terms of the safe money strategy being that you're not going to lose. An FIA, a fixed index annuity, has a 0% floor. So you're not going to lose money from your account balance during the conversion unless you pull money out to pay for the taxes on the conversion, but you're protected at that 0% floor. So it's a safe money bucket. In addition, it gives you a way to do partial conversions. The annuities that we use in these cases are Roth-friendly annuities and allow you to do partial conversions year by year based on tax bracket management. So this is a year-by-year plan where we meet annually to discuss your financial picture, see what needs to be changed, and this just gives you a blueprint structure to understand what makes sense for your unique situation. So let's review the key takeaways. TSPs are designed primarily as accumulation tools, and tax planning requires a different approach than saving. A TSP is a vehicle to help you save money for retirement. Once we get into that tax planning era, we might need a different tool. Roth conversions depend on timing, tax bracket, coordination with other income sources, and your unique financial goals. In some scenarios, Roth-friendly annuity structures may support principal protection and tax payment planning. And remember, Roth conversions are not a one-size-fits-all, and they require individualized planning. This example that I gave today with this case study is one situation of the multitude of situations different than what you're experiencing, and that's why it's important to look at an individualized Roth conversion plan. And like I said before, if you want to explore how to convert your TSP to a Roth IRA using a Roth-friendly annuity, this could also be a 401k, a current IRA that you have, then go to retirementincome.school, click on the book a Q&A call at the top of the page, and we'll create a personalized solution for you based on your unique financial situation and your financial goals for retirement. If you have not yet subscribed to the Retirement Income School YouTube channel or podcast, be sure to do so now. Turn on the notification bell so you never miss a lesson. And continue to stick with me here at the Retirement Income School, where I'll keep bringing you financial education to help you keep your money safe and make it last so you can enjoy retirement. This content is for educational purposes only and is not financial, legal, or tax advice. Always consult a qualified professional before making decisions about your retirement.